Picture this. You invest $10,000. You never check the stock price again, and 40 years later, that investment has grown to over $200,000, completely on autopilot. This is not a fairy tale. This is compound dividend investing. Every single day, millions of people open their trading apps. They watch the numbers flash red and green. They buy when stocks are exciting, sell when they're scary, and spend their nights wondering if they made the right call. Studies show that the average retail investor earns roughly 3.6% annually. The S&P 500 historically returns about 10% per year. So why the gap? Because most investors are chasing price. Here's the truth Wall Street doesn't want you to focus on. Stock prices are noise. They are driven by emotion, by headlines, by fear and greed. The market can be completely irrational for years at a time. But underneath all that noise, underneath the daily volatility and the talking heads on financial news, there is a quiet, mechanical wealth-building engine that has operated consistently for over a century. It is called the dividend. A dividend is simply a share of a company's profits paid directly to its shareholders. When a company earns more money than it needs to run its business, it distributes a portion of those earnings to the people who own it. You own the stock, so you get paid. Think about it this way. When you buy a stock, you are buying a tiny piece of a real business. Maybe that business is a consumer staples company, or a utility company, or a pharmaceutical giant. These are not abstract ticker symbols. They are real companies with real revenues, real customers, and real cash flows. And when those companies are profitable, year after year, decade after decade, they share that success with their shareholders through dividends. Here's what makes dividends special. Unlike stock prices, which can rise and fall by 50% in a single year, dividends are remarkably stable. Companies that have consistently paid and grown their dividends for 25 or more consecutive years are known as dividend aristocrats. There are currently 68 of these companies in the S&P 500, including Coca-Cola, which has raised its dividend every single year for over 60 years. 60 consecutive years. Now here is where things get mathematically extraordinary. Let's say you invest $10,000 in a stock that pays a 4% dividend yield. In year one, you receive $400 in dividends. That's nice, but not life-changing. But instead of spending those dividends, you reinvest them. Now you own more shares. Next year, those additional shares also pay dividends. And the year after that, you reinvest those too. This is called DRIP, Dividend Reinvestment Plan, and it is one of the most powerful wealth-building mechanisms ever created. Albert Einstein allegedly called compound interest the eighth wonder of the world. The math proves the point. That same $10,000 investment, reinvested every year at a conservative 8% total return, dividends plus modest price appreciation, becomes $17,000 after 7 years, $46,000 after 20 years, $100,000 after 30 years, and over $200,000 after 40 years. Now, what if instead of a one-time investment, you added just $200 per month? Over 40 years, that patient, boring, consistent strategy turns into over $3 million. The secret is not stock picking. It is time and consistency. So how do you actually build a dividend portfolio? Let's break this down into a practical framework. First, focus on quality, not just yield. A high dividend yield can actually be a warning sign. As a stock pays a 15% dividend, ask yourself, why? Either the stock price has collapsed, or the company is paying out more than it can afford. That dividend might not last. The sweet spot for dividend investors is typically between 3 and 5% yield, from companies with a payout ratio under 60%, a history of dividend growth of 5% or more per year, and strong free cash flow. Second, diversify across sectors. A balanced dividend portfolio includes healthcare companies, consumer staples, technology firms that pay dividends, real estate investment trusts known as REITs, and financial companies. Third, consider dividend ETFs if you are just starting out. Funds like VYM, SCHD, or VIG hold dozens of high-quality dividend payers, giving you instant diversification for a very low cost. And fourth, and this is crucial, reinvest everything, every single dividend payment. Do not let those dollars sit idle. Put them back to work immediately. Let's talk about what this looks like in the real world. Take the story of Ann Scheiber. She was a retired IRS auditor who made just $5,000 per year during her career. She was not a financial genius. She invested her modest savings into dividend-paying stocks in 1944 and simply left them alone. She never sold. She lived frugally and trusted the process. When Ann Scheiber died in 1995, her portfolio was worth $22 million. Or consider Grace Groner, a secretary from Illinois who bought 3 shares of stock in 1935 for just $180. She reinvested every dividend for 75 years, never touching the principal. When she passed away in 2010, those 3 shares had grown to $7 million. These are not stories of genius or luck. They are stories of ordinary people who understood one fundamental truth. Real wealth is built slowly, quietly, and with patience. Dividend investing is not exciting. There's no dopamine hit from watching a meme stock triple overnight. There's just the quiet, steady accumulation of wealth, year after year. And that quiet accumulation is what actually changes your life. If you want to go deeper on the specific stocks, the screening criteria, and exactly how to build a dividend portfolio from scratch, subscribe to Market Napped and hit the bell. Every week we break down the strategies, the stocks, and the math that help ordinary investors build real lasting wealth. The market is complicated. Your strategy does not have to be. Subscribe and let us build something together.